Greetings, tax tip lovers, and welcome to this week's top 5 tax facts in just 5 minutes. Come gather around people to ponder the story of David, who followed tax advice he found on the internet, where an advisor who should have known better came up with a plan to save SDLT. It seems David was advised that by transferring properties from his own name to a partnership, then into a company, he would save SDLT. Broadly, the partnership was inserted just to aim to avoid SDLT. Well, HMRC didn't agree, and we were approached by David, who asked us to help pick up the pieces. So, what to do? Okay, here we go with a little help from Shampoo from 1994, but it could be the British public's response to COVID-19 in 2020 as we count down the 5 issues. Static at this week's number 5 is, we're in trouble. SDLT rules for residential property transfers are complex, and how a transaction is structured can have a significant impact on the amount of tax payable, especially in the context of incorporations. Down at this week's number 4 is, something's come along. Specialist advice should be sought at an early stage to prevent an under or overpayment of tax. Just inside this week's top 3 is, and it's burst our bubble. Given the potential SDLT savings that can be achieved when transferring property from a partnership to a connected company, investors may be tempted to transfer their property to a partnership and subsequently to a connected company, and that appears to be the advice given to David. A new entry at this week's number 2 is, yeah. However, as David discovered, such transactions are likely to fall foul of the widely drafted SDLT anti-avoidance provision at FA 2003 S75A. Staying at number 1 is the all-time classic, we're in trouble. Well, David had a long-standing accountant, Alan, who first spoke with the scheme architect and then offered comfort to Alan that the proposal looked all right to him. All right it may have been, but effective for SDLT it wasn't. Broadly, the anti-avoidance provision applies where a number of scheme transactions are involved in connection with the acquisition of property. It seeks to charge the SDLT that would be payable on a notional transfer to the ultimate transferee, in this case, the connected company, by reference to the highest aggregate amount of consideration paid or received by any party to the scheme transactions, where that results in more SDLT being payable. Accordingly, where the provision applies, the transaction should be regarded as a direct transfer from the individual to the connected company, and SDLT charged accordingly on not less than 100% of the market value of the properties transferred. And that's what happened in David's case. Where the provision applies and an SDLT return is not filed on that basis, tax-geared penalties can be enforced by HMRC, who have a 20-year window to make an assessment to recover the loss of tax. Well, it seemed to David and accountant Alan to be a really good idea. David had worked really hard to get to where he was, and then he found something which he always thought was too good to be true, and now he knows it was. Okay, that's it. It's time to take action to sort your property tax planning, and here's how. You can do nothing and stay in the exact same place and pay a shed load of tax unnecessarily, or you can follow the link above for a free Power Hour review with property tax experts who are ex-PwC and ex-HMRC, and will make your property tax planning like it was our own. And that's our take on gig-sparing gifts and why we believe you need to take action, tax tippers. So volume up, time to let the shampoo girls tell it better than I ever could. All right, stay bright. Catch you again for breakfast next week. Ta-ra!